Oh, there we go. It's that time of year again. You know, that time of year when Warren Buffett writes his annual letter out. I always love to sit down and read these letters. So I'm going to share this with you guys and girls too. And this letter is his pretty much his outlook on the past year and as they're releasing their earnings for Berkshire shareholders. So this has been going on all the way back to the 60s and 70s. This is someone who has lived through financial crisis, someone who has lived through you know, crashes, the 87 crash, the 2000.com bomb, the 2022, what happened in 2020, 2022 pandemic, 2020 pandemic, 2000 tech crash, the 2008 real estate crash, the 87 flash crash. So he's been around a long time. So I love to read these and see what nuggets I can grab up out of this. So you can go to BerkshireHathaway.com if you want to read this yourself. But let's get to it. So his letters always open up with Berkshire performance versus the S&P 500. That's the top 500 companies in America. As you can see, this is going all the way back to 1965, which was 20 years before I was born. Well, a little bit over 20 years. So it's been a long time. And I'm 38 years old today, if you can't do that math. But here we go. Here, let's stroll down here. So I love to read his letter, right? He says, to Berkshire shareholders, Charlie Munger, my longtime partner, and I have the job of managing the savings of a great number of individuals. We are grateful for the enduring trust and relationship that often spans for more than their adult lifetime. It is those dedicated savers that are in the forefront of our minds as I write this letter. So a common belief is that people choose to save when young, expecting they're about to be maintained their lifestyle and standards after retirement. Okay, people expect to save money while they're young to save money after they retire. Any assets that remain at death, this theory says, will usually be left to their family or possibly to friends or philanthropy. Our experience has differed. Okay, let's see what we got here. Our experience has differed. We believe Berkshire individuals, Berkshire individual holders, largely to be some of the once a saver, always a saver variety. Though these people live well, they eventually want most of their funds to go to philanthropy organizations. Thus, in turn, redistribution of the funds by expenditures of great intended to improve the lives of a great many people who are unrelated to the original beneficiary. So sometimes the results have been spectacular. So pretty much saying people want to save their money, then take their money and give it away. Cool to philanthropy. Okay. The deposit of money unmasked humans. Charlie and I watch with the pleasure the vast flow of Berkshire generated funds to the public needs, and alongside the infrequence of which our shareholders opt the look at me assets and dynasty building. So who wouldn't enjoy working for the shareholders like you? Who wouldn't enjoy working for the shareholders like you? So he's saying that, hey, he's managing money for individuals who are going to build money up. And once they die, they're going to give money back to somebody else, redistributed it back out. So what we do, Charlie and I allocate your savings at Berkshire between two forms of ownership. First, we invest in businesses that we control, usually buying 100% of each. Berkshire directs capital allocations at these subsidiaries and selects the CEOs who make the day by day operating decisions. When large enterprises are being managed, both trust and rules are essential. Berkshire emphasizes the formal to be unusual, the formula to be unusual, some would say extreme to extreme degree. Disappointments are inevitable. We are understanding about business mistakes. Our tolerance for performance misconduct is zero. Okay. He said disappointments are inevitable, meaning the disappointments are going to happen. You're not going to make the money. Company doesn't do what they're supposed to do. We're understanding about business mistakes, but their intolerance for personal misconduct is zero. Okay. In our second category of ownership, we buy publicly traded stocks through which we passively own pieces of businesses. So he's talking about the public market. Let me make sure I'm good to go here. Hold on, y'all. Give me 1 second. 1 second here. Okay. So now he say in our second category of ownership, we buy publicly traded stocks through which we possibly own pieces of businesses. Holding these investments, we have no management in. So when they go out and buy Apple or they go out and buy pieces of Amazon. This is what he's saying. So we seen they were pretty big on I know Apple, and I think Amazon too, and that hasn't been too hot the last year or two. Let's see what they got to say. Our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting, favorable economical characteristics and trustworthy managers. People, please note particularly that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for adequate purchases and sales. That point is crucial. Charlie and I are not stock pickers. We are business pickers. Ooh, that's a gem. I like that one. I need to make that a gem. You see that? What button am I looking for? That's the gem. He said the point is crucial. Charlie and I are stock pickers. We're not stock pickers. We are business pickers. So instead of trying to find a new high flying stock, they pick businesses in the public market. That's a good one. Over the years, I have made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. Along the way, other businesses in which I have invested in have died. Their products are wanted by the public. Capitalism has two sides. That's very key to hear. One of the greatest investors, the greatest investor of all time, sit back and say, I enjoy the very good characteristics of our business, right? And saying that some business done very well. And he says some of the business he had invested in has died. The products are unwanted by the public. Capitalism has two sides. The system creates a ever-growing pile of losers while concurrently delivering a gusher of improved products and services. A creative destruction. So he's like, over time, just the nature of capitalism, you have a trash pile and then you have an extraordinarily good pile. So, okay. So he says right here, one advantage of our publicly traded segment is that our, we'll see where I'm at. One advantage of our publicly traded segment is that it becomes easy to buy pieces of wonderful businesses at wonderful prices. It's crucial to understand that stocks often trade at a truly foolish price, but high and low, both high and low. Okay. It's crucial to understand that stocks often trade at a truly foolish price, high and low. I'm writing this down as I go, ladies and gentlemen. I'm sharing this with you guys as I read it as well. I like that. These are some of the quotes I'm taking out of here. Efficient markets exist only in textbooks. So he doesn't believe in an efficient market. He said an efficient market only believes in the textbook, meaning the market is everything is priced well and you can't beat the market. That's someone who believes the market is efficient. In truth, marketable stocks and bonds are baffling. Their behavior unusually, understandably only in retrospect. Their behavior is only understandable in retrospect. Back now we can look back. See, Apple did this back in 2000 and now it's this. And, so when we look back on it, it makes sense, but we can't look currently into the future. Controlled businesses are a different breed. They sometimes command ridiculous higher prices than justified, but are almost never available at bargain valuations. So controlled businesses are a very different breed. They sometimes command ridiculously higher prices than justified, but they are almost never available at bargain evaluations. Unless under duress, the owner of the controlled business give no thought to selling at a panic type valuation. So when people are going to sell their company, what I'm getting from this is the price is always going to be extraordinarily high. Very rare you're going to see a manager sell off their business at a very low price. At this point, he says right here, at this point, a report card from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. Wow. That's very humbling. Many of my capital allocation decisions have been no better than so-so. In many cases, also, bad moves by me have been rescued by very large doses of luck. Remember our escapes from near disaster at U.S. Air and Solomon. I certainly do. I remember that. I remember Solomon Brothers. He always talk about this. So he said like his bad stuff got, he said in some cases I got rescued by very large doses of luck, where the government pretty much came in and helped him out pretty much for the most part. Very, is the thing about he does not act like, hey, I'm a genius and I know so much and I got everything. He's like, no, I got lucky, man. I got saved at the right time. Our satisfactory results have been the product of about a dozen true good decisions. So he only made about 12 good decisions, what he's saying. That would be one every 5 years. So he's saying he makes one good decision about every 5 years. And sometimes for forgotten advantage that favor long-term investors such as Berkshire. Let's take a peek behind the curtain. Okay, now he's getting into the secret sauce. So he has here the secret sauce. In August 1994, yes, 1994, Berkshire completed its 7-year purchase of 400 million shares of Coca-Cola we now own. The total cost was 1.3 billion. Then a very meaningful sum. At Berkshire. The cash dividend we received from Coca-Cola in 1994 was 75 million. By 2022, the dividend has increased to 704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do, he said, all Charlie and I was required to do was cash Coca-Cola quarterly dividends checks. We expect those checks are highly likely to continue to grow. Okay. So he said they put $1.3 billion in the Coca-Cola and got a $75 million dividend check in 1994. And that dividend check has grown to 704 million off of just dividends. Here's another one. His secret sauce: 1 is Coca-Cola. 2, American Express. American Express is much the same story. Berkshire purchased Amex. It's a Berkshire purchases of Amex were essentially completed in 1995. And coincidentally, almost cost us about $1.3 billion. Annual dividend checks from this investment has grown from $41 million to $302 million. Those checks too seem likely to increase. Okay, that's nice. These dividend gains he said, though pleasant, are far from spectacular, but they bring with them important gains in stock prices. So you say, yeah, we got a big dividend, but we haven't looked how much the stock has grown. At year end, our Coca-Cola investment is valued at $25 billion, while our Amex investment is at $22 billion. Remember, they brought $1.3 billion of American Express stock, and it grew into $22 billion. And they brought $1.3 billion of Coca-Cola stock that grew into $25 billion. Each holding now accounts for roughly 5% of Berkshire's net worth. A kind is weighing long-term, so they weighed long-term on it. So 94 to now, that's what, 6, we're in 23 now, about 30 years. So holding Coca-Cola for about 30 years, essentially, yielding those dividend checks and also having that growth. So that's a pretty good thing. Assume for a moment I had made a similar size investment mistake in the 90s, one that flatlined and simply retained at 1.3 billion valued in 2022. An example would be a high grade 30-year bond. So you said that if I would have just put my $1.3 billion into a bond, that disappointing investment would now represent an insignificant 0.3% of Berkshire net worth and would be delivering us an unchanged 80 million or so of annual income. So you say they'd have been making about $80 million in income, and it would have been pretty flatline. The lesson for investors. Let me see how he wrote this. The weeds wider. The weeds wither away insignificant as the flowers bloom. Over time, it takes just a few winters to work wonders. And yes, it helps to stay early and alive into your 90s as well. It helps to stay early and live into your 90s as well, right? So he lived into his 90s. So he's saying that, hey, he lived into his 90s. And he's saying that the weeds wither away and the flowers bloom. So he's saying those bad investments slowly went down versus the good investments went well, right? The past year in brief. Berkshire had a good year in 2022. The company operated earning expenses, our term for income calculated using the GAAP, which is the general accepted accounting principle, excludes the capital gain losses from equity holdings, set a record of 30.8 billion. Charlie and I focus on operating figures to argue to do well, figures to urge you to do well as well. The GAAP figures absence or adjustment fluctuates widely at every report date. Okay, so nothing crazy here. They're doing a reporting, they're doing a brief year. 100% is misleading. The GAAP earnings are 100% misleading when viewed quarterly, annually, because they're counting capital gains tax. So he's saying that when stocks go up, they're counting that every quarter. So that's what he's speaking about there. Stocks fluctuate, every quarter. A second positive development for Berkshire last year was our purchase of the Allegiant Corporation. I think that's a insurance company, a property casualty insurer. Yep, there you go. By Joe Brandon. I worked with Joe in the past, and he understands both Berkshire and insurance. Align believes special value to us. So delivers special value to us because Berkshire unmatched financial strength allows its insurance subsidies to follow a valuable and enduring investment strategy unavailable virtually to all competitors because they got so much cash and capital that allows their competitors to have a competitive advantage. Aided by Ally Insurance, our insurance float increased from 2022 $147 billion to $164 billion. With the disciplined underwriting, these funds have a decent chance of being cost-free over time. Float money is the money that you pay in insurance that is not being claimed. So every month we pay in insurance, house, car, whatever, we don't pay nothing for it. That's money they turn around and take and invest, float money. Since purchasing our first property casualty insurer in 1967, Berkshire float has increased 8,000-fold through acquisitions, operations, and innovation, though not recognized in our financial statement. This float has been an extraordinary asset for Berkshire. New shareholders can get an understanding of its value by reading our annual updated explanation of float on page Alpha 2, right? A very minor change in our pre-share intrinsic value took place in 2022 through Berkshire shares repurchase, as well as similar moves at Apple and American Express, both significant investors of ours. At Berkshire, we directly increase our interest in our unique collection by repurchasing 1.2 point shares of our outstanding shares. So when Berkshire buys more stock, and in my opinion, that tells me that they believe that their stocks are undervalued. At Apple and Amex, repurchases increase Berkshire ownership a bit without any cost to you. Okay. The math isn't complicated. When the shares goes down, your interest in our many businesses goes up. Every small bit helps. If repurchases are made at a value accelerated price, just assure when a company overpays for repurchases, the controlling shareholders loses. So he says prices go down as they repurchase shares, Apple, Amex, whatever, then prices go up. At such times, gains flow only to selling shareholders to be friendly but expensive investment bankers who recommend foolish purchases. Okay. I want to hear him talk about Amazon. No talks about Amazon. Let me see if we talk about Amazon in here. Gains from value repurchasing gives us the emphasis to benefit all owners when they do shares repurchase in every aspect. Imagine, if you will, 3 full informed shareholders of a local auto dealership, one who manages the business. Imagine further the one who has a passive owner who wishes to sell his interest back to the company at a price attractive to the 2 continuing shareholders. When completed, he has his transactions harmed in one. Is the manager somehow favored over the continuing passive owner? Has the public been hurt? So no. When you are told that all repurchases are harmful to shareholders or to the country or to particular beneficial to the CEOs, you're listening to either economical illiterate or to silver tongue. Okay, characters that are not mutually exclusive. Okay. So right here, he's telling you when you're talking about repurchasing of shares actually helps you. It doesn't hurt you like many people may be falsely intended to believe. So y'all give me one second. Let me acknowledge y'all in this live. That's my guy Al. What's going on, Al? Oh. And we got Mara Hopkins. Has always been Buffett's strategy. Time in the market beats time in the market. Ooh, I like that's a gem, Mark Hopkins. Time in the market beats time in the market. Staying in that market, right? Brandon says, I reduced my portfolio. More KO for me. What's going on? All right. KO for you don't understand out there, that's Coca-Cola. Okay. All right. So let's see what else you got in here. I want to see him talk about that Amazon. What's going on now, Warren? You kind of upset me a little bit. I know you don't care, but hey, yeah, you shouldn't. But I want to see him talk about, I really want to see. I know he was if I'm not mistaken, they were big into Amazon last year. Almost endless details of Berkshire 2022 operations are laid out on page K33 and K66. Charlie and I, along with many Berkshire shareholders, enjoy poring over the many facts and figures laid out in that section. These pages are not, however, required reading. There are many Berkshire centimillionaires and yes, billionaires who have never studied a financial figures. They are simply known that Charlie and I, along with our family and close friends, continue to have a very significant investment in Berkshire, and they trust us to treat their money as it was our own. And that is a promise we can make. Finally, an important warning. Okay, let's see what he got to say here. Finally, an important warning. Even the operating earnings figures that we favor can easily be manipulated by managers who wish to do so. Such tampering is often thought of as sophisticated by CEO, directors, and their advisors. Reporters and analysts embrace its existence as well. Beating expectations is a hearable as a magical triumph. Okay, I think what he knows, what he's saying by that is that he doesn't like to say, oh, beat expectations. He doesn't like to have that. I always know he always said that. This activity is disgusting. Well, that explains it. This activity is disgusting by beating expectations. It is required no talent to manipulate numbers. So he's saying that people can manipulate numbers to make numbers look one way to report, to report beating expectations. So people get big bonuses and things like that. He doesn't like to do that, measuring people by every quarter, every month. He likes to give people 3 years, 5 years, right? Only a deep desire to deceive is required. He said it doesn't require, you don't have to be a sophisticated CEO to fix numbers. You just got to have a desire to deceive. Bold and imaginable counting as a CEO, once the strives has deceived to deception to me has become one of shame of capitalism. So he said it's a shame of capitalism that CEOs go in and like to fix their numbers. Now he goes into 58 years and a few figures. In 1965, Berkshire was a one-trick pony, the owner of a vulnerable but doomed New England textile operation. With that business on a death march, Berkshire needed an immediate fresh start. Looking back, I was slow to recognize that severely of its problems. So there was a textile mill company back in 65. And then came to stroke of good luck. The national indemnity became available in 1967, and we shifted our resources towards insurance and other non-taxable operations. So there was a textile company, and he said that they was on a death march. The company was about to die. 1967, he took all their resources and brought an insurance company. Thus, beginning our journey to 2023, a bumpy road involved in a combination of continuous savings by our owners, that is, in their retained earnings, the power of compounding, our avoidance of major mistakes. That's a big one. He avoided major mistakes. And most important of all, the American tailwind, watching America go. America would have done fine without Berkshire. The reverse is not true. So he said America would have been just fine with Berkshire. Berkshire benefited from it, but he's saying Berkshire wouldn't have been fine without America. So they both needed each other. Well, he needed America more than anything else. Berkshire now enjoys a majority ownership in an unmatched collection of huge and diversified business. Let's look at this first look at the 5,000 or so publicly held companies that trade daily on the Nasdaq, the New York Stock Exchange, and related ventures. When this group is housed, the members of the S&P 500 index, an elite collection of large and well-known American businesses. Okay, in aggravated, the 500 earned 1.8 trillion in 2021. I don't yet have the final results for 2022, using therefore 2021 figures. Only 128 of the 500, including Berkshire itself, earned 3 billion or more. Indeed, 23 million lost money. Let's read that again. So he's saying that out of all the 5,000 publicly traded companies, which are grouped into he said, within this group is housed in the S&P 500. Okay, the 500, the S&P 500 has a total market cap of 1.8 trillion in 2021. They didn't use 2022 numbers because they don't have those yet. Only 128 of the 500, including Berkshire itself, earned 3 billion or more. Indeed, 23 lost money. 23 of the top 500 companies lost money in 2021. Okay. At year end 2022, Berkshire was the largest owner of 8 of those giants: American Express, Bank of America, Chevron, Coca-Cola, HP, Moody's, Occidental Petroleum, and Paramount Global. In addition to those 8 investees, Berkshire owns 100% of BNSF and 92% of Berkshire Energy, each with the earnings that exceeded 3 billion. Mark noted 5.9 billion at BNSF, that's the railroad, and 4.3 billion at Berkshire Hathaway Energy. Whereas these companies publicly owned, they would replace 2 present members. He said these companies were publicly owned, they would replace 2 present members of the S&P 500. So essentially what he's saying is that I have 2 companies that I'm invested in that they was publicly traded. They would top, companies in the S&P 500. We hold 2 of the top 500 companies in the world, pretty much what he's in America. All told, our 10 controlled and non-controlled Boltmans, I can't pronounce that word, leave Berkshire more broadly aligned with the country's economical future than it is a cast at any other U.S. company. This calculation aside, fiduciary operations such as pension funds and investment companies, in addition, Berkshire insurance operations though conducted through many individual management subsidiaries, have value compared to BNSF and Berkshire Hathaway Energy. Okay. As for the future, Berkshire will always hold a buttload of cash, a boatload of cash. I said a buttload, but boatload, whatever. A boatload, same thing. A boatload of cash and the U.S. Treasury bills, along with a wide array of businesses. We will also avoid behavior that could result in any uncomfortable cash needs at inconvenient times, including financial panics and unforeseen insurance losses. So pretty much saying they're going to sit on a boatload of cash because, they don't want to make any type of bad decisions at the wrong time. Our CEO will always be the chief risk officer, a task that is irresponsible to delegate. Additionally, our future CEOs will have a significant part of their network in Berkshire shares. Okay. Additionally, our future CEOs will have a significant part of their network in Berkshire shares brought with their own money. And yes, shareholders will continue to save and prosper by retained earnings. At Berkshire, there's no finish line. So I'm thinking what he's saying here is by, hey, CEOs, they are going to have a significant amount of their network. So it's their money as well. So if their money is tied up into it, they will think about making things different. I like that. Some surprising facts about federal taxes. During the decade in 2021, the United States Treasury received about 32 trillion in taxes, while it spent 43 trillion. Though economists, politicians, and many other publics have opinions about the consequences to the huge imbalances, Charlie and I pled ignorance and firmly believe Firmly believe that near-term economic and market forecasting are worse than useless. Okay. Our job is to manage Berkshire operations and finances in a manner that will achieve acceptable results over time that will preserve the company's unmatched staying power when financial panics and other severe worldwide recessions occur. Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched physical deficits have consequences. Okay, so he's talking about this inflation. Let's see what he got to say. The 32 trillion of revenue was generated by the treasury through individual income taxes, 48%, Social Security and related recipients, 34%, corporate income tax payments, 8%, and a wide variety of lesser levies. Berkshire contributed via the corporate income tax was 32 billion. So they paid 32 billion in taxes during a decade. Also, exactly 1% of all the money the treasury collected. So they paid 1% of all the money that they're saying, hey, we're paying our fair share of taxes. Right? And this means, brace yourself, that there's been roughly 1,000 taxpayers in the United States matching Berkshire payments. No other business or any other country, 131 million households would have needed to pay any taxes, wouldn't have needed to pay any tax to the federal government, not a dime. So he's saying that the money that they paid, they're paying 1% of the taxes to the government. So they're giving back. Millions, billions, and trillions. We all know the words, but the sums involved, but the sums involve almost impossible to comprehend. Let's figure dimensions of numbers. If you converted $1 million into a newly printed $100 bills, you will have a stack that reaches your chest. Perform the same exercise with $1 billion. This is going to get exciting. And the stack reaches about 3/4 of a mile in the sky. Finally, imagine piling 32 billion, the total of Berkshire's 2022 to 2021 federal income tax payments. Now that stack grows to more than 21 miles high, both 3 times the level. He said both 3 times the level at which a commercial plane usually cruises. So he's saying, look how much money they paid in the last decade. $32 billion is what they paid in the last decade of the last year. When it comes to federal taxes, individuals who own Berkshire can inevitably say, I gave at the office. Right? Now give me 1 second. I wonder why my laptop is giving me the low battery signal. So at Berkshire, we hope to expect to pay much more taxes in the next decade. We owe no less to the country, America dynamics, a huge contributor to whatever success Berkshire achieves. We count on America tailwinds through it has become from time to time as it propels us all the way around. I've been investing for 80 years, more than 1/3 of the country's lifetime, despite our citizens' enthusiastic self-criticism, self-doubt. I have yet to see a time when it makes sense in a long term to bet against America. Page 8, I like that, betting against America. All right. Nothing beats having a great partner. Charlie and I are pretty much alike, but we take pages to explain. He sums up in sentences. His version, moreover, is more clear and reasonable than more artful sometimes than added blunder stated. Here are some of the thoughts we have lifted to. He said, here are some of the thoughts many lifted from a very recent podcast. See, even Warren Buffett listens to podcasts. The world is full of foolish gamblers, and they will not do as well as patient investors. If you don't see the world that way it is, it's like juggling. If you don't see the world that way, the way it is, it's like juggling through a distorted lens. All I want to know is where I'm going to die, so I'll never go there. And related thoughts early on, write your desired obituary and then behave accordingly. Write your own obituary, then behave accordingly. If you don't care whether you are rational or not, you won't work on it. Then you will always stay irrational and get lousy results. These are some good quotes he got here. Patience can be learned. Having a long-term attention span and ability to concentrate on one thing for a long time is a huge advantage. Warren and I hated railroad stocks for decades, but the world changed, and finally, the country had four huge railroads for vital importance of the American economy. We were slow to recognize the change, but better late than never. Finally, I always added two short sentences to Charlie and I have been decision clinchers. Warren, think more about it. You're smart. I'm right. You're smart, and I'm right. Okay. He said, you're smart. I'm right. And so goes it. I never had a phone call with Charlie without learning something. And while he makes me think, he also makes me laugh. Okay. I will add Charlie's rule to my own. Find very smart, high grade partner, preferably slightly older than you, and then listen very carefully to what he says. A family gathering at Omaha. Last year, our shareholders got together. In 3 years, we greeted each other. From the opening bell, we strike to our wallets and short. Okay. So now he's talking about on Friday, they're going to have the Berkshire meeting, right? So, moving on questions. All right. So he says, Charlie and I and the entire Berkshire bunch look forward to seeing you in Omaha, May 5th and 6th. We'll be there to have a good time. All right. February 27th, Warren E. Buffett, chairman of the board. So I kind of summed it up, right? Real good stuff there. I had to speed up at the end because I noticed I need to change my battery. He said, what's Brandon wrote down here too? Did I miss something about flying? Does Berkshire still own flying? No, I didn't see them. They got out of airlines not too long ago. Y'all remember? They got out of those airline stocks right in the pandemic. You know, they dumped all the airline. So I didn't see them say anything about Amazon in there, but I'm going to look some more. That's my first look. Guys, I got to get running because I don't want my broadcast to shut off quick and suddenly. But I definitely appreciate y'all for tuning in. I'm going to give y'all more commentary about this. But until the next video podcast, cartoon, that's Warren Buffett 2022 annual letter. Comment what y'all think. To the next video podcast, cartoon, whoever see me do around the globe, peace, be safe. I'm out. Thank you.